Hey everybody, Phil Hodgen here. Hello, fellow tax nerds everywhere. Welcome to the Hodgen Law PC International Tax Lunch. We do this every month on the second Friday of the month, noon Pacific time. You can listen in online, just like you're doing right now, through CalCPA, or later it goes up on YouTube and you can listen/watch then. Um, this month's topic is how to report an accumulation distribution from a foreign non-grantor trust. So the government has these rules imposed for foreign non-grantor trusts to make it basically uneconomical for you to use them. And so there's a giant pain factory, and Deborah Rudd is going to talk about what happens when money comes out of a foreign non-grantor trust and lands in the lap of a U.S. beneficiary. There's a lot of pain in the tax department and a lot of pain in the paperwork department. So you're going to learn about the pain factory today. Anyway, if you have a question during the presentation, just ask it in the box. We'll select a few questions at the end if we've got any time. And with that, I'm going to turn over the headset and microphone to Deborah, and she can take it away.
Hey everybody. So today we're talking about how to report an accumulation distribution from a foreign non-grantor trust. And the topics that we're going to cover, first we'll talk a little bit about why the rules are what they are. We'll look at an overview of the process that you follow if you get one of these projects where you have a client who's a U.S. beneficiary of a foreign non-grantor trust and they get a distribution. As part of that, we're going to take a look at how do you know what kind of trust you have. So how do you know if you fall into these rules? How you know if you have a U.S. beneficiary. And sometimes, you have to include transactions with related parties. So we'll take a look a little bit about that. Loan or distribution. Some loans are actually characterized as distributions if they don't meet certain criteria. So you'll have to report those as distributions. Then probably the biggest part of the presentation will be spending on preparing the tax returns and understanding how to fill out the forms. And then lastly, we'll take a look at fixing problems if you file the return late, or if you're facing a really big tax risk because your foreign non-grantor trust has been sitting there for a really long time accumulating income, and you need to find a way to minimize the tax when you're taking money out of it. So let's get started. The rules exist primarily for two reasons. One is because of data transparency, another is tax deferral, and I'll explain what I mean by those. So we have this diagram here. If you have a domestic trust, the IRS likes these because they're easy to audit. The trust files a Form 1041 with the IRS. It reports its distributable net income. It reports its undistributed net income, the trust principal. A Schedule K-1 is generated and given to the beneficiary. The beneficiary files Form 1040 reporting their income to the IRS. The IRS sees both sides of it. They see the 1041 from the trust. They see the Form 1040 from the beneficiary. All the accounting data is located inside the U.S., and the domestic trustee is within the reach of the U.S. courts. So the IRS likes domestic trusts. There's a lot of transparency. Foreign trusts, on the other hand, present some problems. You have all the same types of income, the DNI, UNI, and you have the trust principal, but there's no K-1 requirement to give to a beneficiary. So if you have a U.S. beneficiary and they're reporting their income on Form 1040 to the IRS, there's no way that the IRS can verify the other side of things because they're not seeing all the same information from the trust that they would see if it were a domestic trust. You have the accounting data outside the U.S., trust isn't filing a U.S. tax return, and the trustee is outside the reach of the U.S. legal system. The other thing we're going to look at here is tax deferral. For a domestic trust, there's no tax deferral. The trust generates income each year. It either distributes that income to the beneficiaries report that on Form 1040, or the trust accumulates income inside the trust, and the trust itself pays the tax on Form 1041. So either way, any income of the trust is going to be taxed. foreign trust, on the other hand, current year income, it distributes some of that out to a beneficiary. If it's a U.S. beneficiary, they're going to pay tax on Form 1040. But any income that's accumulated inside the trust, tax is going to be deferred because there's no requirement of a foreign trust to file a U.S. tax return to report its income. So if you get one of these projects where someone comes to you and they have a distribution from a foreign trust, there's a number of steps that you need to go through, and it's important to do each one of them slowly and carefully, not skipping any steps, even if you kind of know the answer. So you go through all of these questions one by one in order, and then you'll know you've reported everything correctly. So first of all, you need to know what kind of trust you have. Is it foreign or domestic? Is it grantor or non-grantor? And for the reasons discussed above, foreign or domestic, it's taxed differently. Grantor or non-grantor, those are also taxed differently. And we'll talk a little bit about the differences between those a little bit later on. Second, do you have a U.S. beneficiary? This is important to know because if a foreign trust is making distributions to a foreign person who's not a U.S. beneficiary, then it's not taxed in the U.S. You don't have to worry about that. Next, do you have a distribution? And again, this goes back to what I mentioned earlier with, perhaps there's a loan between the trust and another party, but because it doesn't meet certain requirements, that loan is actually characterized as a distribution. So you need to know this, you need to know these rules so that you can report the distributions properly. Next, once you know what kind of trust you have a U.S. beneficiary, and you know they received a distribution, next you're going to be working on preparing the tax return. The most important thing here, as we're going to see, centers on whether this U.S. person who received a distribution from a foreign non-grantor trust, whether they received a foreign non-grantor trust beneficiary statement. If they did receive this statement, it's going to make the tax results much better. If they didn't, it's going to make the tax results much worse, and we're going to have to deal with something called accumulation distributions. There's a possibility, even if they did receive the statement, that they'll have to deal with accumulation distributions anyway. But when you don't receive the statement, you have to follow a mechanical math equation where the IRS tells you, according to their math equation, what portion of the distribution is an accumulation distribution, and it can end up being much, much worse than if the beneficiary did receive the statement. Lastly, dealing with the IRS, is your form late? Is it an amended filing? Are there problems, just like the type of problems I mentioned earlier? Is there a lot of income accumulated within the trust and it'll be really costly to take it out, for example? Lastly, we'll take a look at that and some solutions to those problems. So that's the general process that you're following if you have this type of project. So now we're going to take a look in a little bit more detail at each of those steps that I just mentioned. First is, what kind of trust is it? Is it a foreign grantor trust or a foreign non-grantor trust? This matters for a few reasons. First of all, so you can prepare Form 3520 correctly. 3520 is for people who are owners of a foreign trust, who make contributions to a foreign trust, and who receive distributions from a foreign trust. When you receive a distribution from a grantor trust, it's filled out differently than when you receive a distribution from a non-grantor trust. So you need to know what parts of the form you're filling out, what applies to you and what doesn't. You also need to know whether you're filing Form 3520A. It's required for grantor trusts with a U.S. grantor. It's actually not going to be the subject of most of what we're looking at today because we're talking about non-grantor trusts. Lastly, this is important because you know who pays the income tax. It's either the grantor or the beneficiary. So you know you have a foreign trust if we kind of do this in reverse. We look at these two tests, And if both of these two things are true, then you have a U.S. trust, not a foreign trust. But if either one is false, then you have a foreign trust. So 2 tests to meet. First is the court test, and this says that a trust is a domestic trust if a U.S. court exercises primary supervision over the administration of the trust. And the other is the control test, where a trust is domestic trust if one or more U.S. persons have the authority to control by vote or otherwise all substantial decisions of the trust. So if either one of those tests is not met, then you're dealing with a foreign trust. Next, we need to look at whether it's a grantor trust or a non-grantor trust. And so the easiest way to do this is to look at the rules for grantor trusts. And you see, if I don't meet any of these situations and it's a foreign trust, then what I have is a foreign non-grantor trust. So you know you have a foreign grantor trust if any of these situations are true. First is if a foreign person creates a revocable trust. Second is if a foreign person creates an irrevocable trust and is the sole lifetime beneficiary, or if they and their spouse are the sole lifetime beneficiaries. Third is if a U.S. person creates a foreign trust and there are U.S. beneficiaries. And then lastly, if a foreign person creates a foreign trust and becomes a U.S. resident within 5 years. If you're looking at your situation, you're looking at a trust of your clients, and you see that none of these situations are met, then you're probably dealing with a non-grantor trust. So now you know what kind of trust you have. Next, you need to move on to, do you have a U.S. beneficiary of the trust? This matters because U.S. beneficiaries pay U.S. income tax when they receive distributions from foreign non-grantor trusts. Foreign beneficiaries do not. That makes sense. The U.S. tax system is not going to tax foreign beneficiaries on distributions from foreign trusts. And then also, kind of more importantly here, the first one was more obvious. Secondly, former U.S. citizens and long-term residents are subject to tax on distributions from foreign non-grantor trusts. So people who give up their citizenship, give up their green cards and their long-term residence, these people are going to remain taxable on foreign non-grantor trusts even though they're no longer U.S. people. So the Form 3520 instructions give us a little bit of a definition for U.S. beneficiary. A U.S. beneficiary generally includes any U.S. person that could possibly benefit, directly or indirectly, from the trust, including an amended trust, at any time, whether or not the person is named in the trust instrument as a beneficiary, and whether or not the person can receive a distribution from the trust in the current year. So this could be somewhat broad. Like I said, it doesn't have to be a person named in the trust instrument. So you really have to look at all the documents, the trust instrument and related documents to see whether the person that you're dealing with could be a U.S. beneficiary of the trust. And then, as I mentioned, expatriates, former citizens, and long-term residents, some of them are covered expatriates. The ones who are covered expatriates, they have to continue to pay U.S. income tax on taxable portion of trust distributions even after expatriating. So the U.S. tax system can continue to tax them on distributions from foreign trusts, even though they're no longer U.S. persons. And to determine the taxable portion, you have to assume the person is still a U.S. taxpayer, and then calculate how much of the distribution is taxable. Step 3. So now you know you have a foreign non-grantor trust. You know you have a U.S. beneficiary. Next, you need to know, particularly in the case where there's a loan between the trust and the beneficiary, you need to know, is it truly a loan or is it a distribution in disguise? Trust distributions are cash or property transferred to the beneficiary, loans to the beneficiary or to other people, related parties, that are not quote, qualified obligations, use of trust property by the beneficiary or by other people without paying fair market value, and transfers from a foreign trust to a U.S. person through an intermediary. So the loan issue. Loans in general are all considered to be distributions, and then there's an exception to that where if a loan meets certain criteria, it's what's called a qualified obligation, and qualified obligations are the only loans that are actually treated as loans when they come from foreign trusts. Further, if you have a loan to a person related to a beneficiary, that loan could be treated as a trust distribution to the beneficiary. And the related party rules, you look at Section 267 and 707B for who counts as a related party. And then lastly, free use of trust-owned property as a distribution, or use of trust-owned property for less than fair market value. That is treated as a distribution. The way around that, the beneficiary could pay fair market value for the use of property to the trust. And this, of course, includes use of property by a person related to the beneficiary, because that would be considered sort of an indirect use by the beneficiary. Distributions through intermediaries. This is where someone else receives a trust distribution, then makes a tax-free gift to the U.S. beneficiary. If you do this in a two-step transaction like that, the IRS is going to make the presumption that they should disregard the intermediary and treat this as a trust distribution to the beneficiary under the assumption that there's a tax avoidance motive. And if you do this two-step transaction and it happens, the second step happens within 24 months, there will be an automatic presumption that there's a tax avoidance motive. So the easiest way to defeat that, at least the presumption, is to wait 24 months. But I think if the facts and circumstances still indicate tax avoidance, you could still have some problems there. Okay, so here's where we start to get into preparing the actual tax returns. We're going to look at a couple examples, go through some scenarios, and then show the tax forms. So here on slide 28, we have a flowchart, which takes us through basically the entire process of everything that's going to be filled out, where it's going to be reported, and how it all goes on the forms. So first of all, you're going to be starting with Form 3520. In Part 3, lines 24 through 28, you report the distribution amounts. You tell the IRS the dates of the distribution, what you received, how much it was worth, whether you gave any consideration in return. This tells the IRS the amount of the actual distribution. Next, you select the calculation method. You're either going to be using the default method or the actual calculation method. And this is not just a matter of you can choose whichever one you want to do. There are certain criteria that go into it that determine which one you're able to use. In general, the actual calculation method is going to be a better tax result than the default method. The default method is where we end up with the accumulation distributions and the really bad tax results. So always better if you can use the actual method. But regardless, if you're in the default method, you're going to be filling out Form 3520 Part 3 Schedule A. If you're in the actual method, Form 3520 Part 3 Schedule B. From there, the numbers you calculate there flow to Form 3520 Part 3 Schedule C and 4970. That may actually not be the case if you're using the actual method, because it doesn't always have to go there. But if you are using the default method, you're definitely going to end up there. And then from there, all the numbers flow onto your Form 1040. You report the income on the Schedule E and in other places. If you have an accumulation distribution, that amount just flows into your tax return in the other taxes category. And then also a portion of a distribution could end up being taxable under net investment income tax on Form 8960. So when you're looking at what method can you use, like I said a minute ago, you don't really have free choice here. The actual calculation method, which is the preferred method, you can only use this if you get a foreign non-grantor trust beneficiary statement and if you've never used the default method for that trust in the past. The default method, you're stuck with this if you don't meet the criteria to use the actual method. And this little table here shows why the default calculation method is worse. So just to relate this to the terms that people normally use when they talk about income from trusts. Distributions can come from current income, or the word that people usually use is distributable net income, or DNI. They can come from accumulated income, or undistributed net income, UNI, or they can come from trust principal. And they come out in this order. These are the ordering rules. So if you receive a distribution from a trust, first that distribution comes out of current income, then it comes out of accumulated income, and then lastly it comes out of trust principal. So looking at the actual calculation method, your current income is going to keep the character that it has to the trust. In other words, if the trust has a capital gain and it distributes its current income that includes that capital gain, then the capital gain income to the trust will be capital gain income to the beneficiary. Same thing for qualified dividends and so on. If the trust distributes accumulated income and you're under the actual calculation method, that's going to be taxed kind of as ordinary income, but it gets a high tax rate and there's an interest charge added in, so it's kind of worse than ordinary income. The really bad thing about the accumulated income is that if it's been accumulating for a long time, the longer it's been accumulating, the higher the interest rate is, and ultimately the higher the interest charge is. So if you have a foreign non-grantor trust that's been sitting around for a really long time, that interest charge, this accumulated income section, with the interest charge, this can actually lead to some really bad tax results. And that's true even if you're operating under the actual calculation method, because if it's been sitting there for a really long time, you do have presumably a lot of accumulated income in the trust. And then principal, when you're under the actual calculation method, principal is going to come out tax-free. Now, we can compare this with the default calculation method, where current income does not keep the character it has to the trust, and it's taxed to the beneficiary as ordinary income. Accumulated income, again, stays the same, but it's not a good tax result because you're paying tax at high rates plus an interest charge. And again, if the trust has been in existence accumulating income for a really long time, this amount can end up being very, very high. And then lastly, this is perhaps the worst part. Under the default calculation method, the trust principal does not come out tax-free. And we'll see why when we look at the math equations that we use. But essentially what happens is the entire distribution is assigned either to, quote, current income, which is pretty much an arbitrary number, or accumulated income. There's no part of the distribution that comes out under the default method as trust principal, even if it is, in fact, principal. So if you're stuck using the default method, the entire distribution is taxable no matter what. And it's either taxed under ordinary rates or ordinary rates plus an interest charge. So the default calculation method can lead to some overall extremely high tax results, especially if the trust has been around for a really long time accumulating income. So first, let's look at the actual calculation method. This can be used if you received a beneficiary statement. So the first thing you look at is, did you answer yes on Form 3520, line 30. And that line asks, did you receive a foreign non-grantor trust beneficiary statement from the foreign trust with respect to a distribution? And then if you can say yes to that, you're supposed to attach the statement, and then you complete the schedule showing the actual computation of income. The other criteria is that you have to have a beneficiary statement. And I'll talk in just a minute about what goes on that beneficiary statement. You then have to attach that beneficiary statement to a timely filed Form 3520. So you can't just tell the IRS, yeah, I got a statement. You have to actually show it to them. And lastly, you can use the actual method only if you've never used the default method before. So once you use the default method for 1 year, you're using it again in the subsequent years. There is an exception for that where you can use the actual method in the trust termination year. So the beneficiary statement. Notice 97-34 contains a description of what has to be included in that statement. And you can also find it in the specific instructions to line 30 in the Form 3520 instructions. But just to give a quick overview of that, the things that you have to include in the statement, and the reason I'm giving this is because the IRS doesn't give you a form to fill out for this statement. You have to provide this the trust has to provide the information in the statement, but it can be in any format as long as it meets all these requirements. So it has to tell the beneficiary on the statement the first and last day of the tax year of the foreign trust to which the statement applies, a description of the property, including cash, distributed or deemed distributed to the U.S. person during the tax year, and the fair market value of the property distributed, an explanation of the appropriate U.S. tax treatment of any distribution or deemed distribution for U.S. tax purposes, or sufficient information to enable the U.S. beneficiary to determine the appropriate treatment, a statement identifying whether any grantor of the trust is a partnership or a foreign corporation. Let's see, a statement as to whether the foreign trust has appointed a U.S. agent, and a statement that the trust will permit either the IRS or the U.S. beneficiary to inspect and copy the trust's permanent books of account records, other documents. And this last statement is not necessary if the trust has appointed a U.S. agent. So, again, you can go to look at the Form 3520 instructions or Notice 97-34 for those requirements, but essentially that's what information needs to be there. And it really does center around what was distributed and what character does it take for U.S. tax purposes. So you can kind of think of it somewhat like getting a K-1. So let's say we're in the actual calculation method. How does it work? So you report the distributions and loans on Form 3520, Part 3, lines 24 to 28. You report tax-related information from the beneficiary statement in Form 3520, Part 3, Schedule B. So this will tell you what income you received and what character it takes for tax purposes. Then you transfer those current income amounts from Schedule B of 3520, Part 3 to the appropriate places on Form 1040. And then lastly, you compute accumulation, distribution, tax, and interest on the accumulation distribution amounts if you have an accumulation distribution when you're under the actual method. And that goes in Form 1040 in your other taxes area. The default calculation method, again, this is if the beneficiary cannot use the actual method. So the idea behind the default method is, what if the beneficiary does not know that the U.S. tax, or does not know the U.S. tax attributes of a distribution received from a foreign non-grantor trust? So you don't know if you got some long-term capital gain. You don't know if part of your distribution is made up of qualified dividends. You don't know what you have. So the IRS says in that situation, you're not going to get any of those preferential tax rates. Instead, you're going to use some arbitrary math that the IRS gives you to allocate your distribution as either ordinary income or accumulation distribution. You take the ordinary income amount, you put it on your tax return as ordinary income. The accumulation distribution, you do a bunch of math, figure out how much tax to pay, calculate an interest charge on that, and then you add that into your other tax on your tax return. So you end up with two different numbers on the tax return. One is ordinary income included in your adjusted gross income. The other is a tax calculation that you add in at the end. So if you have an accumulation distribution, you use this formula to figure out how much is the accumulation distribution and how much is, quote, current income. So you add up the distributions received in the previous 3 years, and then you multiply the result by 1.25 or 125%. Then you divide the result by 3 to give you the average. You take that result, and distributions received in the current year up to that amount are treated as, quote, current income, taxed at ordinary rates. Distributions received in excess of that amount are treated as the accumulation distribution. Then once you get your accumulation distribution amount, you do a bunch of math and figure out the tax. So there are some tax rules that apply to both methods, and that is the tax and interest charge on accumulation distribution. But like I said, if you're operating under the actual method, if you have accumulated income in the trust, you're still going to have an accumulation distribution. It's just not quite as bad as when you're operating under the default rules, because the default rules take the whole thing and allocate much more of it to the accumulation distribution. So when you have your accumulation distribution, whether you're operating under the actual method or the default method, you're going to use Form 4970 as a worksheet to calculate the tax on the accumulated income distributions. And then you take the tax amount from 4970 to the 3520, line 49. That's in part 3, Schedule C. And then there you're going to calculate the interest charge on the accumulation tax, and the interest rate is actually just, you take it from a table in the Form 3520 instructions, you multiply it by the tax, and that's how you get your interest charge. And then you take the combined tax plus interest charge and you insert that into Form 1040 as an additional tax. This slide is actually outdated. It says Form 1040 line 62, but I believe it is now a much, it comes much sooner in the tax return now that we're living with the new 2018 version of Form 1040. Net investment income tax. Under the current regulations, this does not apply to accumulation distributions, but it does apply to current income. So let's say you're operating under the default rules and you have to do this math equation where you take the prior 3 years, multiply by 125%, divide by 3, and you get a portion of the distribution that's current income and a portion that's accumulation distribution. The portion of your distribution that is current income is subject to the net investment income tax. The portion that's accumulation distribution is not. So here's, I'm calling it an extreme example. It is an extreme example because it's a sort of unlikely set of circumstances, and it shows a very big swing in tax results that can happen when you do or do not get the beneficiary statement. So on December 31st, 2017, Dad, a non-resident alien, creates and funds a foreign non-grantor trust for his U.S. citizen child, and he puts in $100,000. The next day, on January 1st, 2018, the trustee distributes all of the trust assets to the U.S. citizen child. So you have $100,000 going into the trust, and then the next day $100,000 comes out. Also on that same day, the trust is terminated. So regardless of what tax method we're using, The beneficiary needs to report the distribution on line 24 of Form 3520. So they're going to show that on January 1st, 2018, they received cash of $100,000. They did not transfer any property in exchange for that $100,000, so they put none in columns D and E. And the total value of distributions, therefore, is $100,000. Now let's say that this person is able to use the actual method because they got the foreign non-grantor trust beneficiary statement. What this is going to show, they're going to be able to use Schedule B, actual calculation of trust distributions. And on line 39 there, they're going to enter the amount from line 27. They're going to show that they received $100,000. We know because they got the beneficiary statement that none of that goes on any of these other lines. We go directly to line 43. The entire amount is trust corpus, and that makes sense because the trust was funded and then all the money was distributed one day later, so there was no time for any income to accumulate inside the trust. So this amount treated as trust distribution from trust corpus, this amount is going to be entirely tax-free under the actual method. Now, like I said, this is an extreme example. So let's say that this person did not get the beneficiary statement. That means instead of filling out Schedule A, they're going to be, or instead of filling out Schedule B with the actual method, they're going to be filling out Schedule A, the default calculation, and they have to do this arbitrary math. So on line 31, they enter the amount from line 27, which was the distribution amount, that's $100,000. Number of years it's been a foreign trust. We'll say 2, because it was a foreign trust in 2017 and 2018. Total distributions received from the foreign trust during the 3 preceding tax years. Now, just a little bit of a warning, you could read this line to say, because you're filling out the 2018 tax return in 2019, you could read this to say that the 3 preceding tax years included 2018. That would actually be a wrong reading of this. It's talking about the 3 preceding tax years before the year for which you're filling out the form. So we're filling out the form for 2018. So we're saying, did any distributions come out in 17, 16, or 15? And based on the fact pattern we're dealing with here, the answer is no, because the trust was formed on the last day of 2017. So we have a 0 there. That means when we do the math, where we multiply by 125% and then divide by 3, we're still going to get a 0. And so following down to the end of the section here, the amount treated as an accumulation distribution is the full distribution. It's $100,000. So once you get that accumulation distribution amount, $100,000, of course you have to do the math to figure out what part of it's current income and what amount is accumulation distribution, or you have to, you have to, do the math and calculate the tax on that. The major issue I'm trying to highlight here is the difference between this slide 44, 100% tax-free if you get the statement, versus 100% taxable if you don't get the statement. Now, this is a very extreme example. Most times you're not going to get a trust that's formed, funded, all the money distributed, and terminated all within 2 days. So a lot of times, almost always, there's going to be income accumulating within the trust, either it gets distributed or not, but the facts are never going to be this simple. So let's look at a more realistic example. So we're going to look at a 5-year period here. We have a U.S. beneficiary. In 2014, they received $40,000. 2015, $10,000. 2016, $20,000. 2017, $30,000. And 2018, $40,000. And we need to fill out the tax return and compute their tax for the 2018 tax year. So, first of all, Our assumption is that they did not receive the beneficiary statement, so they're using the default calculation. So first thing they do, they enter the amount from line 27. That's going to be the current year distribution amount, or $40,000. The foreign trust has been a foreign trust for 5 years, so we put 5 on line 32. Total distributions from the foreign trust during the 3 preceding tax years, that's the 2017, 16, and 15 amounts, which were 30,000, 20,000, and 10,000, so we get 60. Multiplying that by 1.25 is 75,000. Divide by 3, that makes the average distribution 25,000. So that means that $25,000 out of the 40 is going to just be treated as ordinary income on the 2018 tax return. So we'll come back to that number later. Next, we find the difference between those two numbers, 40 minus 25, and that result, 15,000, is going to be treated as the accumulation distribution. Lastly, here on line 38, we take the 5 years that it's been a foreign trust and divide by 2 and get 2.5, and we use that number again later. So after you finish filling out Schedule A, if you look at a Form 3520, I couldn't fit the whole page on a slide, but if you look at a Form 3520 Part 3, starting on line 29, this is page 5 of the form, you have the question about did you receive the beneficiary statement, followed by 3 schedules, Schedule A, B, and C, all on the same page. You would think that you jump down from Schedule A and finish completing the form here, but actually you take this number and you go over to Form 4970, a different form. So this is where you do the calculation to compute the tax and interest on, or actually just the tax on the accumulation distribution. So first, amount of current distribution that's considered distributed in earlier tax years. That's the accumulation distribution amount. So that's $15,000. Just for sake of simplicity, I'm putting zeros for some of these numbers. Distribution of accumulated income before you were born or reached age 21. We're not going to worry about that. Tax imposed on the trust, not going to worry about that. We're just assuming that in this situation our facts are pretty simple. So we end up getting to taxable part of line 5 on line 7 here, $15,000. Line 8, we put in the number of trusts' earlier tax years. That's 4 because it's been around for 5 years. Average annual amount considered distributed, so we just take line 3 and divide it by line 8. So we take $15,000 divided by 4. We get 3,750. And then we multiply that by 25% to get 938. And we're going to use those numbers in a minute. So here on line 12, we carry that 3,750 down. And again, that's going to carry to Part 2 of Form 4970. Now here on line 13, these numbers are important too. And this is actually really important if you're following along with the presentation and you're looking at another website or you're looking at your phone right now. Put that stuff down, pay attention. Ha, gotcha. This is really important. You're not going to be able to come back to the slides later and understand what's going on if you don't listen right now. So these numbers here on line 13, what you're supposed to put is not the number that I put here. I just made these numbers up. What you're supposed to put is your taxable income for the years 2013 to 2017, the amount reported by you or is changed by the IRS, include in the taxable income amounts considered distributed in that year as a result of prior accumulation distributions, whether from the same or another trust, and whether made in an earlier year or the current year. So what they want you to put is your taxable income. What I have put is the trust distribution amounts. I did this purely as a matter of convenience because I'm not sending this form to the IRS. I'm doing a presentation on the internet. When you're filling out this form to send it to the IRS, put the actual taxable income. Don't put the distribution amount. Those are going to be different. But I got to break the rules because I can do that. Okay, you can go back to your iPhone now. Just kidding. All right, so carrying on to part 2 of the 4970, we're going to have 3 columns here. And what you do is you take away the highest taxable income year and the lowest taxable income year. So you take the amount from 13 and you take the years with the 3 highest amounts. So just flipping back to the prior slide for a second, that means that we can take out 2014 and 2013 because 2014 and 13 are the highest and lowest numbers. So going back there, we have 2017, 16, and 15. We have 30, 20, and 10. We then take that 3750 that we had calculated previously, add that to those amounts. That gives us our, quote, recomputed taxable income. And we then use the form instructions to calculate the income tax on those amounts. And that basically just uses the tax rate tables to compute the income on that. You then take the number that is actual income tax before credits on line 14 income. In other words, it's a slightly different number because it doesn't include credits. And then the difference between those gives you your, quote, additional tax before credits. If there's a tax credit adjustment, you put it there on line 20. If there are alternative minimum tax adjustments, you put them on line 22. I'm just assuming we don't have those. And then we end up with these numbers here on line 23. Line 24 takes those 3 columns, adds them all up, and we get, in this example, $1,645. Divide that by 3 for 548, and then multiply that by the number of years on line 11. Skipping back up to line 11, we had 4. So we're multiplying that 548 by 4 to get 2,194. So that is your partial tax attributable to the accumulation distribution. And we're not done yet. We have more math to do. So this is the end of Form 4970, but we're going to take this number back to Form 3520 to the Part 3, and now we're going to be on Schedule C. So Schedule C is where we calculate the interest charge. So you notice that on 3520 Part 3, we're filling out Schedule A, skipping Schedule B because that's the actual method, and then using Schedule C because we had a positive number from 4970, so we need to calculate the interest charge. So we have the accumulation distribution, 15,000. Total tax is 2,194. Then we take that 2.5. I told you we'd use that number later. That's half of the years it's been a trust. Then you go to the form instructions. You use their handy interest rate table to get your combined interest rate. For this situation, it's 0.1050. You multiply that by the tax, and you get $230. So you add that together. 2,194 plus 230, and you get $2,424. And that's the total tax and interest charge from the accumulation distribution portion of that trust distribution. So this is how it shows up on your Form 1040. Line 6, I said that $25,000 that was going to be considered ordinary income would show up on the tax return. And here it is, ordinary income, $25,000. Tax on that on line 11 is $1,373. And then further down the form, on line 14, the tax and interest from the accumulation distribution gets added in, $2,424. So you have a total tax, assuming this is this person's only income, total tax of $3,797. And they planned ahead and made an estimated payment of $4,000. So they're looking pretty good. All right, so that's the basics of how you fill out the tax forms. We don't have a ton of time left, about 10 minutes, but I think I can get through this next section. We're going to talk about fixing some problems. One of the biggest problems is you have a foreign non-grantor trust. It's been sitting there for a long time. It's been accumulating income. So if you use the default method, yeah, that's not going to be great. if you use the actual method, in this situation, it could potentially be even worse because you might end up with an even higher percentage of the distributions being classified as accumulation distributions because you have a ton of accumulated income. So people who are in this situation are going to want to know how can they minimize the tax because they're going to be facing some overall very high tax rates on these distributions. So how can we minimize the accumulation distributions? These happen under the default method when the current year distribution amount is greater than 125% of the average distribution for the preceding 3 years. So what you can do is keep increasing the annual trust distributions by just enough every year to avoid the accumulated income distributions. Then everything is simply ordinary income, and that's great. It's not really great, but sort of the lesser of two evils. So here's what that kind of situation would look like. And we picked 12% just because we kind of did some math, played around with the numbers, and found that 12% is a number that kind of works if you use it every year. So let's say in year 1, you get a distribution of $5,000. Prior 3 years total is 0. Prior 3-year 125% average is 0. Ordinary income is 0. So that gives you an accumulation distribution of $5,000. Following year, increase it by 12% or $600. And this time the math works out so that the accumulation distribution is only $3,500. Next year, increase it again. So we're in year 3. That increases your prior 3 years total, and that increases the average. So then when you subtract that average from the distribution for the year, you get an even lower number for your accumulation distribution. Now we're at $1,855. By year 4, when we do this math, we've got an accumulation distribution of 0. And as long as you continue to increase the distributions by the same amount each year, you continue to get 0 as your accumulation distribution. So yeah, you have some, slightly less desirable tax results in the first 3 years. But if you're trying to empty out a foreign trust and you have the time to spend and you can do it over a number of years, this is kind of the go-to method for getting the money out with the least bad tax results. There's also potentially an option to minimize tax by switching to the actual method. This works if you're able to use the actual method in the year of termination. And what I mean by that is you have to actually have trust accounting. You have to know DNI and UNI and trust corpus. Because if you don't, you can't use the actual method because you don't know what numbers to put there. So if you have a trust that's been around for a really long time, no one's been keeping records, no old documents exist that you can reconstruct the records from, you might actually not be able to use this method because you wouldn't know what numbers to put there. But let's say that you can use this method. So, like I said, the trust has to have the DNI, the UNI, and the trust corpus information. And if the trust decides to terminate that year, then the trustee can issue a beneficiary statement, and the beneficiary can use the actual calculation method to compute income tax on the distribution. From what I've seen and from what I've read, this is not always a good thing, though, because if under the actual calculation method you've got a very, very high accumulated income number, then you're still using the accumulation distribution tax on that amount. So in certain situations where there's a ton of accumulated income, it can actually potentially be more beneficial to use the default method. So in these situations, there's sort of no one-size-fits-all solution. You really have to kind of look at the situation as a standalone, do the math, kind of figure out what's going to be the best solution. Now, of course, we can't talk about anything where you have to fill out Form 3520 without talking about penalty risks. So this is a major problem because even now today there are a lot of people who receive distributions from foreign trusts and they don't realize that they needed to fill out this form. The trustee probably didn't give them a beneficiary statement because the trustee didn't know that they would have needed to. So you get a client who's in a situation where you find out that they have a foreign trust, they receive distributions in prior years, and so if they file a Form 3520 now, it's going to be filed late. So if this is the situation, there's actually some very punitive penalties for Form 3520. When you have a distribution and you're filing Form 3520 late to report that distribution, the penalty is the greater of $10,000 or 35% of the distribution amount. 35% can be a really high number if you're getting a big distribution. And then the statute of limitations for the entire tax return does not start running until Form 3520 is filed. So you can potentially create that sort of latent risk that the IRS could always come back and audit your tax return at any point in the future until you file the form, which is not good. There are some options if you have to file the form late. Essentially, it boils down to if you can use the streamlined procedure because you needed to file the form in one of the last 3 years and you meet all the requirements for non-willfulness, depending on how the penalty ends up being calculated, that may be a good option. I've actually worked with clients who that would not work out very well for them financially, and so we used reasonable cause instead. And again, this can be used if the client has the actual criteria for reasonable cause. You might be able to get the penalties removed that way. And lastly, kind of a hidden penalty. If you're unable to provide backup data for either method, when the IRS requests it, then the entire distribution is an accumulation distribution. So it's not a penalty per se, but it kind of is. So that concludes what I wanted to talk about today. I actually have, I think, a couple minutes to do a couple questions. So first, a quick disclaimer. This isn't legal advice. I'm just talking about trusts and stuff in general. I don't know anything about your specific situation. So if you want advice, hire someone competent. And contact information here on the last page. Go ahead and email me if I don't get to one of your questions and you want to talk about it. I have time for maybe one or two. So one of the questions I got is, I'm just going to read it out. So let's say my client is a U.S. child of foreign parents and they have a foreign trust. I think it's a Nongrantor trust, and my client is a beneficiary of their parents' trust. Client has a business run through a C corporation and they want to buy a commercial building. The question is there any problem with the trust making an arm's length mortgage loan to the C corporation? And the answer is, yeah, that's going to be a problem. So a loan to a U.S. person who's a related party to a U.S. beneficiary is treated as a distribution to the beneficiary. And you under Section 267, I forgot the exact paragraph under that section, but a wholly owned domestic C corporation is related to its 100% owner. So that means that the corporation doesn't have a private party mortgage from the trust, and instead this is considered to be a distribution to the U.S. child. And a better solution actually in that situation would be to have the trust make a qualified loan to the beneficiary. What they call it on the Form 3520 is a qualified obligation. And there's a few requirements you have to meet. Has to have a five-year maturity, a certain interest rate. There has to be a written document. There's a couple others. They could use that as a temporary financing and then pay it off with a proper bank loan as soon as you can arrange it. That would be a better situation. And then I got another related party question as well. This one relates specifically to slide 24. It says related person, does that include a foreign person too? For example, if the trust loaned money to a foreign spouse of the U.S. beneficiary, would that be considered a trust distribution to the U.S. beneficiary? And actually, there was a project I did recently where this was the scenario, and sections 643I, pretty sure, says that United States persons who are related, it says that United States persons who are related are the people that you need to look at as the related parties, which seems to exclude foreign spouses from the related parties for this purpose. So interestingly, I think the foreign spouse of a U.S. beneficiary would actually be okay in this scenario. There are more questions, but we are out of time, so I'm going to turn this back over to Phil for the closing remarks. Thanks, everybody. Email me if you have any more questions.
All right, I pushed the mute button temporarily. Sorry about that. Thanks all of you for showing up and listening in today. I like to joke that our job here as international tax people is we just do plumbing for money. It's all buckets and pipes. And so now you've heard a little bit about one of the categories of buckets for money that we deal with, which is trusts. The other one, of course, is multinationals like cross-border corporate structures. And next month, by coincidence, is me talking about topic on that, little mini multinationals. So this is August 9, which is Friday at noon Pacific time. I'll be talking about Section 962, where a U.S. humanoid can elect to be taxed as a C corporation. And you'd think that would be a good thing because tax rate for C corporations is 21%. Humans get taxed higher, but it's not all rainbows and unicorns. So I'll be talking about that next month. If you're not already on our mailing list, go to hodgen.com/newsletters, sign up, and you'll get notification for all this stuff. And if you're already on the mailing list, hey, send a friend. Anyway, we'll see you next month, and I'll turn it back to our friends at CalCPA.